Well, I mean, I guess I'd say not very many people, but for a very definite reason. And that is most people in this business are trying to make money for themselves rather than for their shareholders. And so they're not focused on giving the shareholder the best break. And if you think about it at all deeply, you realize that the stock market creates nothing. It reflects the returns earned by investors, by Investment America, the corporations of the country, the public corporations. And they have earnings, they pay out dividends, they reinvest the earnings in the business. That's where the value is created. You access that value through investing. So then the question is, corporate America has created this kind of value. What comes down to Investment America? And the answer is exactly what they earn, except that it's then the question is, how is it allocated between Wall Street, essentially the financial system, and Main Street, the people who invest? And the allocation to Wall Street is the objective of this business because everybody is in Wall Street. And what we should be doing is working, and what we have been doing here at Vanguard, is putting the investor first and innovating for the investor and not for ourselves, and trying to keep costs as low as we can, which is rock bottom.
I want to go back to something you mentioned a minute or two ago about the importance of fees and really looking at what you're paying for that return that's being created by corporate America or corporations around the world, and then the fee that is the one interruption for you to actually getting that return. Would you suggest then that somebody who's going through and evaluating a mutual fund to purchase, and there are sites and services like Morningstar and others that have all of the ratings and reviews and they tell you about the manager and all the rest, would you say that the best thing that someone could do would be to remove all of those factors and just rank them by fee and buy the ones that have the lowest fee? If you could do that without looking at anything else, obviously you'd end up with a number of Vanguard funds because your fees are average 0.12%. But is that a better methodology than the average person is using to pick a mutual fund?
Well, I'm tempted to say, and will say, ask Morningstar. They say that their sophisticated rating system works almost as well as simply rating the funds by cost.
Wow.
So they have entered the confessional booth. The problem is, in the financial business, value and cost are the reverse sides of the same coin. When you go into Costco or anything else you can think of, there's a value in your mind. You buy a Mercedes-Benz, you get a lot of value out of driving. Now, I don't know why anybody would get any great pleasure out of that, but maybe it's pride. Maybe they think Mercedes-Benz is a new star somewhere in the sky. I don't know. But you can't directly associate the cost with the value. But in the mutual fund business, it's how the returns are divided up between the marketplace and the investor. So this is a hard business to do it in without giving up your profits. Get costs out of the equation. I mentioned to you the magic of compounding returns over the long term, the mathematical magic of it. The problem we have in our society is that magic, on the record, is overwhelmed by the tyranny of compounding long-term costs. And I gave you that example of 7% gross return, net return, 9% gross return, and it's cost you 70% of your capital over your lifetime. Be aware of that. You read in the Wall Street op-ed yesterday that the market will then get inefficient, start to get inefficient as you creep into the 80s and 90% that's not traded, just means a reduction in trading volume. But the reality is that it may get less efficient and it'll be much easier to win. But it will also be much easier to lose because the average manager is always going to do the same as the index because they own the same stocks. That's what the market is. It's a universe. This much is indexed, this much is held by active managers. So you will probably see at some point a division between, if you get way out there, years and years, decades from now, the market does get less efficient. But it doesn't, it will make it easier to lose and easier to win. You can never look at the market without realizing that for every buyer there's a seller. It's a very kind of simple thing that people seem to forget. So I don't worry about that. I do worry about the lack of competition in indexing. The big three, so-called, you mentioned Vanguard and BlackRock and State Street, there's very little competition. We Vanguard are 80% of the traditional index fund market, And nobody wants to compete there. The competition is over in the exchange-traded market, which is a very different piece of cake, and not as good one, I'm sure, not as good a track to be on at all for the investor. And so why don't more people join? Because all the damn money goes to the investors and not to the managers. It's not an attractive business proposition. And the mutual fund industry is basically an industry that is trying to make money on the return of the manager. And of course they want to make money on the returns of the people that invest with them, but they're greatly handicapped by the fact that their prime job is to run a corporation in the traditional way, see how much profit you can make. And the more the manager takes, the less the investor makes. This is just the truth. Well, I fall back a lot of the time on Adam Smith, who wrote his stuff, as it were, in 1776, more or less. And I rely on the invisible hand of the investor to do what's best for himself and therefore change the world for the others. The matter is not in Wall Street's hands. The matter is investors' hands. And if brokers or firms or mutual funds that trade too much are doing the clients a disservice, this will become very apparent and the clients will move their money. That's why we had this huge move into indexing, which is now, I think, 40%, almost 40% of all mutual fund, equity mutual fund assets. Wall Street is a great marketing machine, a great selling machine. And if stocks don't trade, Wall Street makes no money. There was a cartoon in Barron's some years ago with a sober-looking announcer from CNBC saying, there was no trading on the New York Stock Exchange today, as all investors were satisfied with their positions. And that's the Nirvana day that I'm looking for. Because we trade with each other. There's no gain to be found for the market. I trade with you, I may be right or wrong, you may be right or wrong, and there's only one person that makes money, the croupier in the middle. So people will get wise to that, and they will get wiser, kind of the example I gave at the beginning, when returns are lower. Cost, 1%, 2%, let's call it 2%, of a 4% return is half of it, where of a 15% return, we enjoyed 17% actually in the 80s and 90s, it's only 10, you're still left with 15 after the 17% returns for each of those 2 decades, unprecedented in American history. So experience will tell, and they will be moved by what the customer wants, what the client wants. So there should be less trading, even as we bring the exchange-traded fund into a whole new world. Now, ETFs account for somewhere between 30 and 40% of the trading in the New York Stock Exchange every day. There has to be something to sell all the time in Wall Street. And you know, with all due respect, I mean, it's an honest trade, but there's just too much of it going on, and it can't win. Because if trader A wins, I mean, I don't want to beat this to death, but I might as well make it clear. Trader B loses. And so trading is a loser's game.
Stock market is just a big gambling machine, and it's probably rigged too, so I don't invest.
In the short term, the stock market is a casino. That's correct. In the long run, it is not a casino. It's a machine for compounding interest and returns, which, as Einstein said, is the greatest miracle in financial history. The chapter in my book on ETFs is called A Traitor to the Cause. Traitor, not traitor. Wouldn't dare say that, but it is that too. I'm bothered about ETFs. They are, think about it this way, that we have passive investment strategies, call it indexing. And there are 2 groups that own them, passive investors and active investors. And the traditional index funds, TIFs I call them, an acronym which has never been picked up by anybody but me in 4 years or 6 years, and ETFs, to give you the bouts. And ETFs are clearly passive funds owned by active investors. Active investing is trading. Active investing is speculation. Active investing is losing. And ETFs are a loser's game. Let me be very clear about that. Well, we have the miracle of compound interest working for us. And when you invest over 20 years, 30 years, 40 years, 50 years, for today's young people, an investment lifetime is probably 70 years. Their life expectancy today is, if you're 20, is probably 90. So you're going to be, and then you're going to be investing, after you retire, of course, and presumably that's in your 60s or 70s for some people. And
not you, but
not me. But that curve is just a sweeping curve, and it's the miracle of compounding returns, and it pays off hugely. Albert Einstein called compound interest the greatest financial miracle of all time, or something like that. So take advantage of that, and the only thing that gets you out of it, focus on the long term. Time is your friend. But if you get distracted by the ups and downs, mostly by the downs, people respond much more nervously to downs than they do ebulliently to the ups, although that happens too. But impulse is going to get you in and out of the markets. But think about this. When the market is low, it's low because people like you are really worried. And that's a good time to buy stocks, essentially. There aren't any rules for this. And if you're ebullient and feel very wealthy and want to buy stocks, that's at the high. In other words, if you're discouraged and selling at the low and aggressive and buying at the high, your money isn't going to last very long.
What about risk? How do you assess risk? If we're now saying, oh, put your money in, let it ride, add to it over time, start with $15,000, you find yourself 40 years later, you're going to have $900,000 or something approximating that, depending on how the overall market does in the next 40 years. But what about larger risks? What risk could reasonably threaten that in the next 40 years? Or are you telling your grandchildren in their 20s now, just go with this game plan?
Well, I do for my grandchildren. They can change it when they get there. They don't really know how much money I put away for them over all these years. And I always put it in balanced index fund. 60% S&P 500, or total stock market, I should say, and 60% total bond market.
60 and 40. You said last time we talked that anyone watching could put all of their money into that one fund and make it their sole investment throughout life.
Now, it's conservative, and it protects you against your emotions, because when the market goes way down, stock market goes way down, the bond market actually usually goes up a little bit under that circumstance. So investors have behavioral problems, and they panic if their account goes down 50%. An account like this probably goes down 32 or 3%. Okay. So you don't get exposed to the worst of it. There's no question that a 100% stock portfolio will do better in the long run. I mean, that's just the numbers. Stocks will return over the long run, not every 25-year period, but probably 3 out of 4. Stocks will return more than bonds. They will be the highest returning investment because they have a higher risk. Now, what is risk? Let me tell you what it is not. It is not volatility. We use volatility to measure risk. You know, if the market goes up, let me say, or down 25%, and you own the market, that's what you do. If you want to reduce the volatility in a balanced fund, you maybe go up or down 15%. And if you want to get an extremely aggressive fund, maybe up and down 40%. But it's symmetrical and fairly symmetrical. And so that's a way of measuring, but it's a short-term thing. In the long term, the risk is that you may lose one hell of a lot of money. If you started buying stocks in 1919 or 1920 or 1918, you were doing fine through 1929, and then you lost 90% of your money in an all-stock portfolio.
And it took you another 15 years to get back to even or something.
Yeah, actually a little more than, just about right, 15 years in mid-40s. And so those kind of risks are big risks. And they're risks that we can't measure. There are risks that come from things like, what is the probability that our society will collapse? What is the probability that with all the undercurrents that are going on in American society between the haves and have-nots, and the haves, the superior, larger races and the minorities, those gaps are very wide, and I'm deeply concerned that we may get in some real trouble, and that's why I describe myself as so conservative that I'm liberal. I want to protect our society, and therefore I want to protect those segments of society that haven't been treated fairly to the best of our ability. And then there are the known risks, like nuclear war, worldwide disease, plague kind of thing, religious uprisings, the things that we know about and worry about today. And then, as my fellow Princetonian Secretary of Defense Donald Rumsfeld says, those are the known unknowns. And what about the unknown unknowns? And of course, since they're unknown, we can't comment on that, about that.
But none of those unknown unknowns, or none of those big risks, cause you to change your investment approach, I guess, because the assumption is if the market goes down 90% on the Bogle family portfolios, that there are so many other problems in the world, it's probably not going to be a make or break thing for you that your stock portfolio is down.
Well, no, as a wise man once said, if there's nuclear war, it won't matter a hell of a lot whether you own stocks or bonds. It's gone. Society is gone. It's frightening to think about. And I think that given the enormity of these kind of risks that I've described and the unknown risks that we really don't know, we don't know what they are, which is kind of frightening. But invest you must. As I've said to people, probably on television or interviews kind of thing, the one way to assure that the value of your retirement plan is zero is to not invest a penny. And zero is guaranteed. So you have to put your money to work. In the extreme circumstance, even cash is not going to help you. It's not going to be any good if the nuclear bombs start going off. It's a frightening, fragile world that we live in. So you can sit and worry about it every day. And, in certain respects, if you like to worry, it's a good thing to worry about. But you kind of have to get on with your game, prepare for the future, and hope that those extreme risks don't come home to roost. Concerned, angry, astonished. There is a fringe element. It's almost entirely in the ETF industry. That's a marketer's dream. People that have no background in the business, Henry Kaufman calls them financial buccaneers, come into the business with a hot idea. And they want to sell, I won't name any names, they want to sell what's ever hot. And you've read interviews with these managers in Barron's, kind of frightening. And they say, well, I know that Japan and Europe, two of their funds, are currency neutral funds, aren't going to last forever. So we'll think of something else when they fail. Was that the way to be in this business? To market products? I don't even like the word product. I banned it here, actually, years ago. It'd come back. I used to pay a $5 fine if you ever mentioned it. I didn't think we were manufacturers selling products. I thought we were trustees selling fiduciary services. People would say, that guy is a real sap, and he probably is. But I have an idealistic view of the business. Well, the book is premised on a wonderful story, which I really ought to tell you, and that is the story of Kurt Vonnegut, the famous author, and Joe Heller, author of Catch-22, and even more successful author. And they went to a party given by a billionaire on Shelter Island, and right off Long Island there, kind of lifestyles of the rich and famous kind of place. And they get in there, and Kurt says, Joe, see that man over there, our host? He's a billionaire. He's a hedge fund manager. And he made more money today, on this one day, than you have made with every copy of Catch-22 that has ever been sold. And Joe Heller looks over at Kurt Vonnegut and says, that's okay, because I have something he will never have: enough. Well, we're actually talking to all of the above, Pam, and that is the money section is about the sins of our financial sector in this economy. Too much overreaching, too much greed, too much lack of awareness of risk, too much financial engineering, making numbers look better than they are. And then I go from there, from the financial sector to business itself, where any aspect of professional behavior and professional conduct and the ethics that go with the role of a professional have been reduced greatly, if not abandoned in many cases, in favor of business, business, business. The idea is to make a buck in this bottom line society, and we've gotten, I think, too much focused on, let's say, the ephemeral, too much focus on charisma, and not enough focus on the eternal and not enough focus on character. So business, general business, in the U.S. particularly, but all over the world, and part because of greed, human greed, has gotten the message wrong. And then finally, the third section of the book is on us, if you will.
Us meaning the ordinary investor, the ordinary working person.
The ordinary citizen.
Right.
And that's the part that's the life part. How to live a life, an enjoyable life where you have enough. Now, a good question is, what is enough? And I think that's the question you ask. And I don't know really how to answer that question. I don't think anybody, because it's a very personal thing. It certainly has a lot to do with things other than money. You know, it has to do with serving the community. It has to do with being a part of a family and raising a family. It has to do with how we handle our colleagues. It has to do whether we make a contribution to the welfare of this great land of ours. And it also does have to do with money. And where money comes out, because we all want enough so we're not burdens for our children or whatever it might be. And the best definition I could come up with comes from the Roman poet Horace, a couple of centuries back there. And he said, look for the golden mean, somewhere between the agony, the ignominy maybe of a hovel, and the envy of a palace over here.